Hello friends, in this lecture we shall discuss mock test with explanation relating to JAIIB principles and practice of banking. So here are our questions. The first question, which of the following does not match? Let us see the options. Regulator of insurance market is IRDA. Correct answer. Regulator of capital market, SEBI, Securities and Exchange Board of India. Regulator of money market, Reserve Bank of India. Regulator of foreign exchange market, SEBI. So let us evaluate these options. Insurance market is regulated by IRDA, correct? Capital market is regulated by SEBI. Money market is regulated by RBI. And foreign exchange market is regulated by RBI. So here option D is the correct option because it does not match. So regulator of foreign exchange market is the RBI and not SEBI. Regulator of foreign trade is DGFT, Director General Foreign Trade. Let us see second question. The corporate securities are held in electronic form instead of physical form by whom? So the corporate securities like shares, debentures, bonds, they are kept in electronic form instead of physical form. And who is keeping this? Let us see the options. The registrars, custodians, depositories, mutual funds. Friend, these are all intermediaries in the capital market. The role to keep electronic form, to keep the corporate securities in electronic form is performed by depositories. Hence, our option is C. The depositories hold the corporate securities on behalf of corporates in electronic form. So these are also known as demat securities. RBI acts as banker to central government on what basis? And state governments on what basis? Friends, Reserve Bank of India is acting banker to central government also and banker to state government also. So what are the basis of that? Let us see the options. By agreement with central government, by agreement with state government. Mandatory for central government on agreement with state governments. By agreement with central government and mandatory in case of state government. So it is mandatory for central government, it is mandatory for state governments only. Friend, Reserve Bank of India is a banker to central government and it is mandatory requirement of RBI Act. As regards state governments, the state governments can enter into agreement with RBI to function as a banker to state government. Hence, our answer is B. It is mandatory requirement for central government and it is on the basis of agreement with the central government. So RBI act as a banker to central government. It is mandatory requirement. For state governments, it is on the basis of agreement with the state government. As per RBI regulations, the banks should not sanction new or additional loans to the borrower appearing in RBI list of willful defaulters for a period of from date of publication of list by RBI. So as per directions of Reserve Bank of India, banks are not supposed to sanction new loans to those borrowers who are willful defaulters of other banks. And this is up to a period of, let us see our options. Option A, 2 years, B, 3 years, C 5 years, 4 10 years. Friend, this restriction is up to 5 years. Hence our option answer is C. The period is 5 years as fixed by RBI to discourage willful default. When banks have business relationship with industrial and business entity, this is part of which type of banking? So banks deal with individual customers. Banks also deal with industrial and business entities. So this part where banks are dealing with industrial and business entities, this is part of which type of banking? A. Universal banking, international banking, wholesale banking, retail banking. When banks are dealing with industrial and business entities, so this is part of wholesale banking. So our option is C. It is called wholesale banking. In this type of banking, the banks have business relationship with large corporates and trading houses. In case of retail banking, it is with individual customer. In case of international banking, so this is a type of activity when banks are operating outside country also. Universal banking means doing all types of banking business. Global depository receipts are normally traded on. Global depository receipts. They are sold and purchased on US stock exchanges, European stock exchanges, international stock exchanges, Indian stock exchanges. Friend, global depository receipts, they are traded on European stock exchanges, and American depository receipts, they are traded on US stock exchanges. Indian depository receipts, they are traded on Indian stock exchanges. Hence, global depository receipts, they are traded on European stock exchanges. So that is our answer. So GDRs, that is global depository receipts, they are sold and purchased on European stock exchanges like London Stock Exchange. The value of loan amount under retail lending normally is in the range of. So when we say it is a retail lending, what is the size of that loan? So what is the general practice? Rupees 10 lakh to rupees 10 crore. Rupees 5 lakh to rupees 5 crore. Rupees 10 lakh to rupees 1 crore. 20,000 to rupees 1 crore. Friend, when we say retail lending, the amount is restricted up to rupees 1 crore in general, normally. But when we talk about Basel Committee guidelines, the retail lending includes loans up to 5 crore. But here our question is normally. It is not in terms of Basel Committee. So our answer is 1 crore. So the range is between 20,000 to rupees 1 crore. In case of what type of share? If the dividend is not paid in the particular year, it gets accumulated as arrear and is paid in the subsequent years. So we have to name that share where if dividend is declared but not paid in that particular year, it becomes a liability of the company. It gets accumulated as arrear and it has to be paid in the subsequent years. Let us see the options. Preference share, convertible preference share, cumulative preference share, participating preference share. Friend, such type of share is called cumulative preference shares. Cumulative means where the dividend gets accumulated as arrear. So our option is C. In a cumulative preference share, if dividend is not paid in a particular year, it gets accumulated as arrear and is paid in the subsequent years. In a payout day, the payment and delivery of securities is made. So this is a question in the context of stock exchanges. In a payout day, the payment and delivery of securities is made. Here are our options. By one broker to another broker. By broker to the stock exchange. By stock exchange to the broker. By one stock exchange to another stock exchange. So in a payout day, the payment and delivery of securities, it is made by stock exchange to the brokers. Hence, C is our answer. So payout day is the day when exchange makes payment for the securities or delivers the securities to the brokers. As against this, there is pay in day when brokers make payments to the stock exchange. Well friends, we shall continue with such lectures in others lecture also. Thank you for watching this video.